Rich, just as a beginning point, do the earnings today matter?
I mean, they matter from the standpoint of it's yet another signal that the online ad market is slowing. You saw it from Snapchat last night. You've seen it from Twitter. There are now just a building series of signs that the economy is slowing and advertising is slowing, whether that's inflation driven or just overall broader economic weakness. It definitely, look, there's very specific Twitter challenges with Musk, but the overall macro environment is clearly weighing. We'll see the big bellwethers in Google and Facebook next week, but this is certainly not, these are negative data points, both of them for investors right now.
Well,
in this sector.
Rich, I got to rip up the script here. Let's jump over to next week. Are we going to see the big boys, and frankly, including the Amazon advertising model, are they going to be diminished as well?
I mean, look, Google has been talking about YouTube bearing some pressure. I think there's no doubt the connected TV ad market is certainly slowing. I think you're going to hear that, whether it's from Fox or Paramount. Like, I think everywhere you look, connected TV is slowing. The TV market, especially local TV, is starting to slow. The economy is weakening from the standpoint of advertising. Companies are seeing top line growth slow. What do? They cut back on marketing spend. This is not new. I mean, you and I, Tom, have lived through multiple cycles over decades. Like, this is what companies do. When things start to slow, they cut their marketing spend. There's nothing shocking about it. The question is only how long will it last and how bad will it be? Is this a deep, dark recession through 23 where ad spend gets crushed? Or is this more of a shorter term phenomenon and we bounce back in 23? And I think that's the big question. We don't know right now, but I definitely think you'll see Meta. I keep saying Facebook. We will see Meta certainly talk about a slowdown in a continued slowdown in ad revenue and probably give relatively underwhelming Q3 guidance. I don't think as bad as Snapchat, but I don't think it's going to be a great, great outlook for them.
Well, for Rich, to bring it back to Twitter, they did talk in the statement about those advertising headwinds, but they also said part of it's reflective of uncertainty related to the acquisition of Elon Musk. What is your base case about what the verdict will be in that Delaware court in October? Is he going to be forced to buy this company for $54.20 a share?
We really do believe he's going to be forced to buy this company for $54.20, Kaylee. He signed this agreement when the case in Delaware, which is going to be litigated on an expedited basis. He already lost the push to push this out. I think my guess is the judge is going to look at this and go, the entire Elon Musk case essentially rests on this question of bots. And did Twitter disclose the proper amount of bots? The problem with that, Kaylee, is when you read the merger agreement, it never talks about bots. There's no discussion of bots. It just relies on Twitter's public filings. And if you read Twitter's public filings, it says, this is how we count bots, or this is how we count real users, but we could be wrong. So I think when you actually read the documents, it's very hard to see how Elon, feels like he's got buyer's remorse. He just doesn't want to buy it anymore, whether it's the market, the environment, I have no idea.
Well, to that point, Rich, what happens to a company if someone is forced to buy it who doesn't want it?
Well, first of all, it's happened before. The specific performance, which is being forced to close a transaction that you signed back in the financial crisis, there is precedent for being forced to buy a company. That's his problem, not Twitter's.
Rich Greenfield, very quickly here, and I want you to take a broader Walter Piecyk, Rich Greenfield view. Is there profit in streaming? Is it a durable business, or do they compete it all away, spending $200 million on the gray man?
Tom, it's an excellent question. I think the way to answer it is right now you are seeing one company make a lot of money, which is Netflix. Netflix is generating $6-7 billion of EBITDA, is generating $1 billion of free cash flow, and is going to make dramatically more free cash flow next year. Everybody else, whether we're talking about Disney Peacock is losing $2.5 billion a year. Paramount Plus lost $1 billion in the last 2 quarters. Everyone is just drowning in red tape right now. I mean, this is like a black hole of streaming because there's too many companies competing and they don't generate a significant amount of time spent in streaming. Netflix is 30% of all time spent streaming on a connected TV. YouTube is 20%. Everybody else is tiny. And that's the problem, is they're all spending billions upon billions of dollars and they're not getting substantial viewership. That's the problem.